if we zero in here, not just on active, but on active ETFs, which of course have been the sort of talking point in European ETFs this year. When we ask investors about active fixed income and what are their key concerns within that area, they cite to us, first and foremost, lack of track record, lack of product availability or range, and maybe then performance issues. How can asset managers, and particularly JP Morgan, who are sort of the key player within this market in Europe at the moment, how can you sort of give investors more confidence in these strategies?
You know, it's a good question. I think, and it's definitely something that that clients are thinking about at the moment. And the way we've thought about it is to effectively build on our fixed income franchise. So what we've looked at is developing and bringing product to market that are using a tried and tested process. So they're using the same portfolio managers, they're using the same investment process to basically take the track records that we've built through mutual funds, through segregated mandates, and bring them to the ETF wrapper. So really it's just the vehicle rather than the strategy. And I think coming and looking and adding and increasing our availability in the ETF products should be a big benefit. So I think that is really what I would say. There is no difference between looking at the mutual fund, looking at the ETF. It's the vehicle. It's the same investment team behind that. So the other thing we've been looking at is making sure that we have all the right strategies for all the major categories. So we've got 6 with JP Morgan Asset Management. We've got 16 active fixed income ETFs covering all the major product categories, whether it's government bonds, corporate bonds, high yield, emerging markets, to make sure that clients have that offering available depending on which sector of the fixed income markets they're interested in. I think the really interesting kind of thought process as we go forward is just looking at the active passive split between mutual funds and ETFs. Now, if you look at the mutual fund categories for fixed income in the UCITS range, you're about 80% in active, 20% in passive, so a much heavier weighting towards the active side. Complete contrast in the ETF space. So for ETFs, latest numbers I've seen is that it's about 97% passive, 3% active. Now, I know a lot of people, a lot of investors use the ETF more as building blocks, so maybe the active-passive split doesn't go all the way through to the mutual fund split, but I just feel that 97% to 3% passive to active, that's just not the right mix. And I do feel that there will be more investment in active fixed income ETFs over the coming quarters and coming years, and should be taking more of that kind of share away from the passive side of things.
And that, of course, is being played out in flows numbers that we've been seeing over the past few years. I think it was 2022 or 23, we had net outflows from active fixed income ETFs in Europe. Then that went to 2.5 billion inflows in 2024, and we're already sort of cresting above 6 billion inflows so far year to date. So as the product range expands, it'll be interesting to see how that story plays out in 2026.
It will be, and I think what you're seeing, I think there's going to be a general interest, continual interest in fixed income overall, because if you think about what's been happening over the last few months or so, is rates have been coming down, so cash rates have been coming down, yield curves finally are steep, so the benefit of moving out of cash into fixed income is there, so investors can't sort of keep that argument to stay in cash because it's higher yielding anymore, so they will move into fixed income assets to try to get that additional yield, which I think they will be then moving into ETFs as part of that fixed income basket. And then I also think they'll be moving into active fixed income ETFs, because I think it makes a lot more sense as to be an active investor within the fixed income marketplace compared to being just passive.
So fixed income is back, active has arrived.
Definitely.
Thank you, Iain. And thank you very much for joining us for this edition of Investment Insights. Until next time, take care.